Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to explain our max gain and max loss calculations in the positions view and show you some of our favorite tips for navigating the dashboard, like how to view the trade history for each position. Matt, do you want to share a screen and get us started?
Sure. So yeah, let's back up there. What we want to do today. So this is all about risk and about knowing how your positions are going to fare if the market goes way up, way down, or stays the same, or does many other things. But usually, people want to know for stocks, especially, how they're going to do if the market goes down, or at least you should be. We used to watch this like a hawk when I had a market making firm and I backed traders, and we'd watch this every day, even live throughout the day, where risk was, we would have calculations that said, okay, what's the worst thing that could happen to Amazon, let's say? It could be taken over and the volatility will fall to zero, or it could have an accounting irregularity and the volatility goes way up or something like that. So we would be able to run through the riskiest or worst things that could happen in a stock, and then that helps you trade around it. I mean, you can either buy puts or buy a put or something, and see how you want to reduce some of the risk that you had. So that's what we're really talking about today, and how to look at risk at the option level, how to look at risk at the spread level, and how to look at risk at the symbol level, and I guess overall at for all symbols, Tyler.
Yeah, and we get a lot of questions about it too. I think there is a lot that kind of goes into this max gain and loss calculation, and a lot of people look at it in different ways. So it's going to be nice to have some clarity on the matter and how we look at it at ORATS. You obviously have a lot of experience, like you said, so I'm excited to learn a little bit more about it.
Yeah, I mean, definitely we could have more explanation on here, but at least we have the numbers, and we'll tell you how it goes, and Auto knows, and we'll have some mouse overs maybe a little bit better. See, but they're there, but maybe we have like a question mark or something where people could see it. So firstly, let's start with something kind of easy. So let's start with a long put. So here's a long put, way out of the money. Amazon's trading 250. In 39 days, you have the 195 put. You could see on this graph potentially that it's quite out of the money. So let's talk about what this graph is showing. So firstly, this graph is a distribution you can see, and it's not quite a normal distribution. You could see like a little blip there and a blip up there. This is an actual distribution of Amazon moves over 40 days, looking at historically back to 2007 and doing some slight adjustments for how much volatility was in the market back then.
So that 40 days, that's from the position, right? So if
39 days.
If you were looking at a position that had a week expiration, then it would be a week distribution.
Yeah. So let's just look at that example that you just made just there. So let me go to a position where I have, for example, different. I don't want to do that. Where I have different expirations. So okay. So here's a put in SPY at 232 days. So at 232 days, the lowest calculation that we do is with the SPY going down from 680 to 420. So 260 points down, that over 232 calendar days. Okay, so that's that's a 3 standard deviation move for that particular day period, right? So, but if we look at, so remember that 420. So if we look at, 11 days out, so here's a put that the lowest is 612. So you could tell that we're looking at a standard deviation based on the implied volatility right now in order to draw this graph. So does that answer your question, Tyler?
Yeah.
Okay, good. So that's how we draw the graph. So so now you could already know. Oh shoot, there are different risk profiles for different days to expiration. So we need to factor that in. So anyway, let's go back to our example here. So now we've looked at risk from an option level. So let's look at risk from a spread level. Okay, so in a spread, you generally have two or more options. Often they are offsetting risk. So in this case, I never like to be short units. I never like to be short a call or short a put. And so this is a short put spread. So we're selling a 220 with the stock at 248 put, and we're buying that 195 that we talked about before. So you may know immediately that caps your risk. So 220 minus 195 is $25 is the most you could lose. But you also get credit for buying it. So right now in the market, the value of the short put spread is $1.25. And so the most you could lose is not 2,500, it's 2,500 minus the 125 or $2,375. So that's the worst you could do on this position at expiration if it goes all the way through both strikes, or at least finishes at 195 or below. And you can see that in this payoff diagram here. Anything under 195, you've experienced max loss. Are you okay so far, Tyler?
Right. So then why is that different from what we see when you in the row above? And then also, is there a way to get to that number from the legs below it? Like, are we adding it up or subtracting it? How are all those numbers there related?
Yeah, that's a good question. So yeah, what makes it difficult is it's not additive, which is to say, when we say what the max loss or the max gain is for any one option, that's 3 standard deviations either way. Actually, I suppose that you could add the max loss with the max gain, but that doesn't always work. So 4,100 minus 1,700 is about negative 2,400. So that's you could do it that way, and I suppose also 167 minus 45 is the 122 max gain. So it works in this case. It doesn't work in every case. So it's not always additive up. But does that answer your question?
Right. So the individual legs are a 3 standard deviation move based on the DTE of that leg. So that's why you see kind of such a high number there.
Right. So you can see like at the bottom here, right? It's
right.
continuing to go. Like it's
right.
theoretically infinite or zero. Like if the stock goes to zero, you've lost, $220,000 or $22,000. But
right.
But you have again limited at your risk right at the 195 to that 2,300, and you could see it reflected on the graph here.
Right. That makes sense.
Okay, good.
So what about that top row?
Yeah. So we know that, right?
Mm-hmm.
So now you say, okay, well, what do we do if we have different numbers here? Like, what do we do if we have like like in the SPY case, what do we do if we have, an 11 DTE, an 18, a 232? How do you marry all these? So that's the tough part, right? So what we would always do, from a trading firm perspective, is we would say, well, let's just look at what would happen if the stock goes up or down, just in general to these positions. So, like 1 day out, 2 days out, 3 days out, so what we do is we make 1 day, the standard deviation isn't great enough to make a big difference. So we found that like at 3 days, 3 standard deviations is, a good number to see a good amount of risk. I don't know if that makes sense or not, but, which is to say, like, if you want to look at a position, you can't. It doesn't really make sense to look at the max loss of a 232-day option where you could lose, $15,000, because it could move down to 420. Well, a 1 day option is not going to move down to 420, most likely. So you have to say, okay, well, how are we going to look at all my positions together and come up with some type of a overall profit and loss, based on where the market can go. Does that make sense?
Yeah, I'm curious how that works for positions with less than 3 days to go.
Well, all it is, the reason that we use 3 days is we just say, well, we want 3 standard deviations up or down. We don't really like move the DTE out, because if you move the DTE out past your 0 DTEs or 1 DTE or 2 DTEs, then it's just going to be basically stock. So we don't.
Okay.
We just use the 3 day standard deviation in order to calculate what where the stock could most likely move within 99% of the time. That's just a kind of a normal distribution type calculation, but triple the day. So we've given ourselves, we want to protect from catastrophic risk. There are a lot of 5 standard deviation moves that, if you move a 1 day option out 3 day over a 3 day standard deviation range, 3 standard deviation range, that gets to be like 5 standard deviations. So you get what it just widens the amount of movement that you could model in this over time. Does that make sense?
Yeah.
Okay. So then what we do is we say, okay, well, now we have, rule. Like, so, when you pull up, a strategy, you could see, that there's a gray line there. And should we tease out the other graph that you have, Tyler?
Yeah, we can show the work in progress.
Okay, this is a work in progress. No, but this is, just a bigger. We've been asked a lot for having bigger payoff diagrams, so it's a lot easier to see on this payoff diagram here. We've had our trade profile for many years, but now we're just making it bigger basically here. So now we're able to see this position on, and then if I zoom out, like the 651, we have, that's worth 91 cents. That's out in 1121. This is 1111. So this expires today. Yeah. And these are farther out, short put spread. Or this is a long put. Yeah. So this is a short put spread. So you could see that there's, not only the expiration move, but there's also a line here that's kind of the line today. Or you could, change that line to, move it up or move it back. You can't move it because we have this one. So we could take that position off. Let's just take that one short position off, and then we can model this a little bit easier. So here's what the position looks like without that long 0 DTE or 1 DTE, as we call it, position. So it's just a short. It's a short put spread. We want the stock to finish up here, so we're slightly long. So you could see I could add a Greek overlay. I could add delta, and then if I mouse over here, my delta's 0.14. My delta is 14, meaning we're long delta. So we want it to go up. Clearly, we don't want it to go down here where we could lose money. So we're long delta, but we also have 11/21. So we have 10 days for this. So we have 10 days until we get this kind of green and red line here. But today we have this kind of gray theoretical line that's going through right here. So this gray today what's the value, and then we can adjust. So we can move that. Like you could see it moving like the day before expiration. It gets more. The purple line, which is the gray line, today's profit and loss. The purple line is how many days you're sliding it out, and it gets closer and closer to the expiration line as you move towards this expiration here. Does that make sense, Tyler?
Yeah, I really like this IV term structure mini graph in the top right. It kind of it makes it intuitive. That slider on the x-axis, the theoretical value, it kind of makes it intuitive.
Yeah. So as you get closer, you could see this purple line moving towards that line over here.
Very cool.
Yeah, so that's what happens to this line. So what we can do, just if you have a bunch of different positions, you could take this kind of gray line for every position and say where the profit and loss is going to be, for not only your SPY positions, but for you could kind of theoretically use it for any position, because we have this distribution, this standard deviation distribution for every stock that you could theoretically overlay against each other and be able to see your overall risk position. And that's what we're kind of teasing out, that we'll have, in the coming weeks or months here, the ability to really see your overall position, because sometimes you don't know. Like you're looking, like I have all these positions. This is my paper trading account, but I have all these positions on, and I could see my max gain and max loss. This is actually pretty good. You could kind of see that. Okay, I'm long game. So I have some protection on the downside here. We'll talk about that in a second. And then so I have some losses over here. So my max losses and max gains, but you don't know if they're max losses going up or max gains going down or what. So whereas it's nice to see, it's not very informative until you start to overlay them, think about correlations and be able to adjust things like that to really, what you want to know is what happens if the market goes down 5% tomorrow. Like, how am I looking? And 5% what? Like in terms of SPY. So if SPY goes down 5, Meta is probably going to go down more percent. So, for example, we in that case we have Meta, we have that distribution. So that distribution kind of normalizes things. I know that's pretty theoretical, but what we're trying to do is make it easy to see something technically complex and trying to simplify that complexity. Does that make sense, Tyler?
Yeah, I mean it's a tough thing to do because there's so many ways you can look at risk. We're choosing to do the 3-day 3 standard deviation move, but yeah, there's a lot of things you could do, and there's a lot of positions to look at. So I think we do it a good way, and the new risk profile tab is going to really help visualize that kind of stuff better.
Right. And it looks a little bit funny here, but but eventually when we get to being able to adjust all of the positions and get them all on one graph and look at them, it's going to be a lot more intuitive. But kind of the reason that we have so much curvature here is this one put. So if we took out that one put from the positions, that's going to change things quite a bit. So if we take that's this one. So if we take that out, because if I want to know what I'm looking like tomorrow, right? And not just today. It looks a lot different. Now I have some pretty great risk down there. So like those are the types of things that you want to look at when you're looking at your positions. Like, oh shoot, like, wait, I could lose $3,000, with a big move past the standard deviations, right? So we could see 3 standard deviations. Maybe you could see that on here is at this point right here. But you could see it continues out. So if there was a big move, really big move, multiple standard deviation move, we're in a little bit of trouble. Of course, I'm always protected, but so it's not unlimited risk. But this is pretty. You could tell I don't want to be screwing around with the stock going down here longer term.
Yeah, I think what's helped me understand the distribution a little bit better is the probability of profit calculation. So maybe you can explain a little bit about how we derive that number, and it kind of makes sense then what those little numbers on the distribution nodes are showing.
Yeah, so I mean, you were very interested in what all these percentages are, right? And those percentages show, historically where the stock has moved for this. Now we're looking at a I think it's a 3-day moves. So most of the moves you could see that like markets are kind of skewed to the upside and they have long tails on the left side. That's just how stocks tend to move. And so what you can do is you get a much more accurate probability of profit if you have a distribution that's more accurate. Like if you're just using a normal distribution and using a probability of profit calculation that kind of off the shelf, you're not going to get the right calculation. So what we do is we say, well, we know where the profit for this position is going to be had. Now we just need to do an expected return calculation by multiplying 4% times whatever that is, whatever the profit is, 6%, or actually, I guess in probability of profit, that's an expected return that I was talking about. But probability of profit is just counting the percentages that are green versus the percentages that are red. They both add up to 100%. But so, probability of profit in this case actually looks pretty, it's pretty high because most of the distribution is in the green. But the expected return might be a little bit different of a story because there's such the magnitude of the negative is bigger. Does that make sense, Tyler?
Yeah, sometimes it surprises me that theoretical value, that gray line that we're looking at, is kind of so low because of that high probability of profit. Like if you just go slightly to the left of where we're at today, it starts to dip into the negative. Why is that?
Well, you're not going to make money on this position until time moves on. What you don't want is movement before time. And that's what the black line is showing. The black line is just showing, dude, you're screwed if it goes down today, right? You need time to pass by for this position to make money. So that's, I think, answers your question.
Got it. Okay. And then,
but that's things that you can learn from this, and when you're able to overlay, your entire positions from 230 days to 11 days, you could kind of get a picture of what you're kind of rooting for and your position, I know, but like this is way down, at 610 is my, is where things don't go well. Another thing that you could do, in this case, you can move the day out, moving volatility, a bit could be interesting to look at, and how does that change things? So, there's a lot that you could do to kind of, make this a little bit more accurate. Like, so we'd want to know, like, what's our Vega down here? So, like you could see your volatility, so we have some Vega as it goes down. So that's going to help us offset the negative, because as stocks go down, volatility goes up, and we have Vega. So that's kind of good for us.
It really is a cool way to visualize where your risk is at. It's going to get even better when we overlay multiple positions on there.
So people are going to say, where is this? I want it. It's coming out. We're working on it. We're just teasing it out right now. And why don't you leave in the comments if you want to see this, if you want to see anything different on this, or what you use to visualize your risk, and what you think is important, and did we miss anything today in the discussion?
Yeah, thanks, Matt. That it's exciting stuff, and risk is complicated. So, we want to serve you guys the best we can. Matt's got a lot of experience in risk, so we think we're doing the right thing. But definitely, if you guys have any feedback, let us know.
Yeah, and it just shows, like, tomorrow, right? Like, after I have a long put that's here that's kind of protecting this position. I'm going to not have that, right? So, like, in our current risk, we see, a positive. We don't see any negatives, what we call slides. So if we go back to the positions, for SPY, you'll recall that it's positive both areas, right? And you'd be like, oh, no problem, right? Well, that positive is coming largely from this one put that's just kind of sitting there protecting your position. And that, once that's gone, and it's only 15 cents, once that's gone, you have that extra degree of risk that we saw in the much more in sharper contrast in the graph that we use. So it's important to, and that's what we would do a lot on the floor. We would take positions out of our overall portfolio to see, well, in 2 days or tomorrow, what if that is gone? Then how do I look? So then I know I have to do something either today in order to move that. If I still want to protect my position like I'm protected now. So that's the benefit of it. Like, the benefit of seeing this risk is doing things about and knowing what's going to happen, but also doing things, making decisions, and knowing, hey, I know that I'm taking this risk. So it's always a risk return type thing, and how much risk are you really taking in order to make a certain amount of money? So that's what we look at, Tyler.
All right. Yeah, lots to learn. Thanks, Matt, for sharing your wisdom and the tools that we're making. If you guys have any questions, definitely leave a comment. If you guys have any suggestions as well, please do that there. We also have our AI chat agent, Auto, in the top right corner of our website and dashboard that you can ask about risk and max gain and those types of calculations, our distribution calculation. That kind of bleeds into the distribution edge, which we've talked about on other shows. So there's a lot to learn about ORATS and risk, and we're releasing new tools all the time. So thank you for watching, and thank you, Matt, for sharing all that. Thank you, Tradier, for hosting. We will see you guys again next week.
Thanks, Ed.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.